start, we're going to go over the residual earnings model. The residual earnings model, that's the model I want you guys to use for valuing Canadian Pacific. This is straight out of the slide in Penman in the book, and we're going over here Nike and how the book is doing it with Nike. So the idea is that, how do we work through this? We initially want to look at what is the earnings per share. What is the earnings per share? And you have that data in the Zacks report, plus you multiply this out by 1.19 to value it further out. So you do that, and then you go through this process of identifying, okay, what is the book value per share of the company, and what are the earnings that are just regular earnings, which means what's the risk rate of the company? Say it's 9%. How much earnings would they expect just for the book value? There's no earnings to substantiate any value further than that. So you're like, oh, well, you know, it looks like the RE charge, what we call, is the amount here. That's how much they want. That's how much they would want for just the book value of the company in terms of earnings. Anything beyond that is indicating that, oh, we have more earnings than the risk of the book value. And that means more value than the book value. So what do we do with this? We take the present value of residual earnings, and we take the present value of residual earnings over the next 5 years at our discount rate, right? At our discount rate. So this is the residual earnings, this is the discount rate, and this is the discounted residual earnings. And we have a continuum value based like anything else, which is our final value in the final year, right? Which is 2.108 times the growth rate, right? Times the growth rate, and we know our growth rate has been 19% actually in earnings. Pretty amazing. And then we look divided by the risk rate minus the growth rate, and we get the continuing value. And that way, this whole picture comes together. This is basically your per share. This is your per share value of the company stock. The two assumptions that you really have to look at in here is the growth, right? So that's being given to you as 19%, so it's something we have to look at. Is that really 19%? But try it first. And the risk rate of the company, which I would say, you know, look at it, but, you know, essentially it looks like 10, 12% risk company. So you want to put that in there and look at that risk and look at the value that you're getting. And in this context now, you know, what's the book value per share? You calculate it. What's the assets minus liabilities of the company? Okay, divide that by the number of shares. That's book value per share. There you go. Book value per share is whatever it is. What's 10% of that? Okay, that's the RE charge. You know, you look at EPS minus the RE charge, book value times 1.1% times 10%. That's going to be your excess. How many? What are the residual? What are the earnings beyond the requirement, which is book value times the risk rate? So it's something you can just exercise, and once you deploy this over 5 years, from 2015 to 2019, you start getting a value here. You start getting a value. How close is that to where the current trading price is, or whatever that was, 183, 193? How close is it to Zacks future estimate, which is a little bit above that? That's when you start seeing, like, listen, you know, is the 19% really accurate? Or is the 19% really sustainable? You know, are you using the right risk rate for the company? You know, what is the cost of equity of this company? Right? Traditionally, cost of equity could range from 7% to 10%. You know, you have to look at the capital structure a little bit. But this is the idea of the model. You get in here and you sort of model this out, and you get a value. You know, you get a company value, and when you have that, and we go back into our assignment detail, and I just want to walk you guys through this. Now, if you go back to Zacks, you got to start looking at this and be like, okay, listen, I have something. I have something here. I'm starting to get a stock price. I'm starting to get a market cap. Now, the next level of the project is fundamental analysis. This is something that Warren Buffett does. You got to stay and be like, listen, what is the growth rate of this company? What is the growth of the revenue here? What is the growth in EPS? So you start looking at it, you want to determine the growth rate because that really drives the valuation. So you want to start looking at this number. That's when you zoom in and you say, yeah, that's the financial part. You're done with it. I want you to learn how to manipulate that financial part according to your economic research. And in a way, this course, I want all of our studying, each week we're going to add another layer. What is standard deviation? What is beta? What is international hedging? We're going to go through that on a weekly basis now. But I want to use all this stuff in the context, how does that affect the valuation? I want to apply that right away. So in the next video, I want to go over the economic research. I want to start connecting this a little bit to what is Southwest going through right now? I mean, what is Canadian Pacific going through? And what are the top points that we're discussing here now in terms of the specific services and the specific things that our freight revenues are coming from? And I want to look at the grain, coal, and sulfur landscape in North America to really understand, hey, where is this revenue coming from, and why is this company stock gone up for 50%? Why is Bill Ackerman, a hedge fund manager from Pershing Square, involved on the board of directors of this company? Try to see a little bit in depth what is going on here, and why has this company been so hot? And the question is it going to be hot or is it a good short idea? So that's what I want you guys to take a stance and sort of go through that. So in the next video, we're going to go ahead and deeper.